Hello everyone. In today's video, I'll explain what liquidity is and what the terms buy side and sell side mean. I think this is a topic that probably concerns many of you, I would say. Depending on how long you've been involved in trading, you've definitely heard about liquidity before. And to understand what liquidity is, it's first important to understand what buy side and sell side is. Buy-side liquidity is found above every swing high that has not yet been taken out by the market. So let's say right here is where we are in the market. This is our current position. Then we have all these swing highs here that haven't been taken out by the market yet. And above these highs is what's called buy-side liquidity. On the other hand, sell-side liquidity is found below swing lows. So under every swing low here that hasn't yet been taken out by the market, there is what's called sell-side liquidity. So what exactly is that? Liquidity, buy-side and sell-side are stop orders placed by traders. When banks want to load their huge orders, they obviously need, if they're going long, a seller for every buy, and if they're going short, a buyer for every sell. That's the principle of the market. Every buyer always needs a seller, and every seller, in turn, needs a buyer. Markets, or more specifically, the big players, cannot simply load countless orders without always having a seller for all those buy orders, for example. And it's exactly the same the other way around. Accordingly, they rely on this important liquidity that lies just above these highs. You can already see, if we look at the market here, you can see how many swing highs we have. And as we mentioned, above each of these highs, there is a stop order from traders. A trader who is in this downtrend and trading short always places their stop order above a swing high. And the stop order for a short is always a buy stop order. And conversely, anyone who goes long here and sets their stop loss below a low has a sell stop order placed here. In other words, there are endless buy orders here. Someone is buying here. There is always someone buying the market. As soon as we take out these highs, someone is buying in this market. This is absolutely essential because when the banks load their orders, they always want to sell at these swing highs since they are already in profit. In other words, they rely on traders having their stop losses above all these highs so that every time we take out one of these highs, they can sell and countless traders then get stopped out and buy. That is liquidity. If someone wants to sell, then there must be someone on the other side willing to buy. That's why we talk about buy-side liquidity above highs. And on the other hand, if I want to keep selling, I need someone who is buying. And that's why we talk about sell-side liquidity. It's a bit complicated if you don't yet have a clear idea of what exactly this means. I still hope it was reasonably understandable. To sum up, here's what you should take away from this video. Above the highs is buy-side liquidity, meaning buy orders from retail traders, and below the lows is sell-side liquidity, meaning sell orders from traders. Every buyer needs a seller, every seller needs a buyer, and that's why it's necessary for these stop-loss orders to be triggered by the big players so that they can start realizing their profits and selling here, while others get stopped out and end up buying the market. As I said, I hope the video was understandable. If you have any questions, always tag one of the fauna in the questions channel and you'll get an answer as quickly as possible. See you in the next video. Bye.